But as we've always said, be careful when gold starts to prepare for a rip, because when that happens, things are going so badly in the world, and they're becoming more and more obvious that, be careful what you ask for. Gold can certainly protect you against failing bond markets and diluted, debased currencies, but it can't protect you against all the other things that are going wrong geopolitically, with our personal rights, with our civil rights, with our censorship, and the other problems that are happening in the U.S. and in Europe. So, it's a good news, bad news scenario, but I think for gold investors, again, I'll say it with conviction, its time hasn't even come yet.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 9th through October 16th, 2023, while supplies last. This week we feature two different specials: Silver Morgan Rounds at $2.09 over spot from CNT, and half-ounce Gold Eagles at $1.15 over melt. First, the Morgan Round from CNT celebrates the classic Morgan dollar, but is 4 nines fine and 1 full troy ounce of silver. It's also IRA eligible, and at just $2.09 over spot, a great way to stack 4 nines fine 1 ounce silver at a low premium. Next, the Gold Eagle is one of the most popular gold bullion coins in the world, providing incredible recognizability and investor trust. The half-ounce Eagle adds a further degree of flexibility and liquidity. They come 42 a tube and are available at just $1.15 over melt while supplies last. They're also IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Great to be back, Elijah, as always.
Well, it's great to have you today. I wanted to discuss oil and the petrodollar today. I know you recently wrote an article on the decline of the petrodollar, and this really ties into what is happening with oil right now. There is obviously conflict or war between Israel and now. I did want to ask you about that, how this all plays into the petrodollar right now.
Yeah, there's so many fluctuating currents and headlines changing every day. And of course, over the weekend, what's happening in Israel is going to have, I think, massive ripple effects. And then you tack onto that oil policy in America and the West over the last couple of years. It's all kind of converging. And I think, as many have said, oil is more powerful than the Fed fund rate. And it's a powerful energy source, despite trillions spent in going green, which haven't really moved the carbon neutral position in any way. We have to come to the realpolitik that oil still matters, despite all types of efforts. I think the combination of Powell raising rates at the same time that Biden's administration has been trying to legislate oil out of existence almost. It's an exaggeration, but not entirely. When you raise the cost of the U.S. dollar and the cost of debt for higher for longer, that makes CapEx for the oil producers in the U.S. harder. It makes oil more difficult to extract. We've got declines in the Permian Basin. Our strategic petroleum reserve, which had over 600 million, I think, barrels over a year ago, now has just over 300 million barrels. And I think our weak point is once you get to 200 million barrels, we're really at risk. So we've got a very low SPR. At the same time that we're seeing production cuts out of OPEC in the Middle East, and then now we have a major conflict in Israel, which is going to have, I think, ripple effects with Iran and certainly already Lebanon and other areas. So there's a lot of unknowns. What we do know is basic supply and demand. We have greater demand and less supply and greater need. So the oil price is going to be going up. And that, of course, has an inflationary effect at the U.S. and in the West. So these are all adding to the inflation pressures. In terms of the petrodollar, even before this breakout in Israel over the weekend and all these geopolitical issues, even before that, I've been arguing for a long time. We've been talking about BRICS moves and commodity moves and, UAE and Saudi Arabia making overtures with the BRICS countries. I've been arguing for over a year that the real question to me with the petrodollar was more important than whether there was an official gold-backed BRICS currency. And I mentioned that in the 70s, it wasn't easy for Saudi Arabia to agree to having the US dollar be the petrodollar behind oil. That creates a massive amount of global synthetic demand and is a massive support for the US dollar. Kissinger and Nixon were running around trying to convince Saudi Arabia and OPEC countries not to worry. We're going to raise interest rates by massive levels. We're going to strengthen the dollar and make that more attractive as a petrodollar or a backing for oil. You know, you fast forward some 50 years later, the dollar is still relatively strong based on interest rate policies at the Fed, but the yield on the 10-year still isn't nearly what it was, and the real rates aren't nearly what they were in the early 70s. And then so OPEC has been raising its eyebrows thinking about the longer-term relationship of the petrodollar. And again, when you look at the volatility in the oil price before we went off the gold standard in 71, and then you look at the volatility in the oil price after we dropped the gold chaperone, the US dollar wasn't necessarily the best thing for stable oil pricing. You combine all these factors coming together, the supply and demand mismatch, geopolitical issues, problems with the US dollar longer term, problems with rising yields, not nearly what they were in the 70s. The dollar, the dollar just isn't what it used to be. And the petrodollar isn't what it used to be. And I think that's a greater threat longer term. It's not going to happen overnight where the petrodollar disappears. But as you see Saudi Arabia moving towards the BRICS and away from Biden, you know, Biden, for better or for worse, should openly declared that Saudi Arabia was a pariah state. And, you know, the famous fist pump with the Crown Prince versus the handshake that the Crown Prince gave to China's leader, it suggests a drift away from the US dollar. And so these are all slow forces that are coalescing. What's happening now in Israel, which again is so soon to call, but I have a feeling it's going to have ripple effects with Iran. Up until last week, the U.S. was even talking to Iran about making some oil deals, which was otherwise unheard of. So there's all kinds of shifting events happening at a rapid pace, and yet there's these longer-term trends that have been happening slowly over the many years to make Saudi and other Middle East countries rethink their relationship with the dollar. If there's even a minor decline in the US dollar's role in the oil price, and if the BRICS countries, which are clearly heading in the direction of getting more for their commodity energy prices in the East than they are out of the commodity pricing based out of London or New York, you're going to see increased slowing of demand for that US dollar, increased distrust of that US dollar. At the same time, with this supply and demand mismatch, that's going to send energy prices higher at a time where America and the West in particular really can't afford those costs. It's going to have massive inflationary effects, despite what the Bureau of Labor Statistics describes current inflation, which we can talk about. The mismatch, the official number and the real number are extraordinary. But I think between Biden's policies, with oil in general, with Powell's rate hikes, with the shift towards the East and the BRICS, the movement away from the US dollar, the increasing distrust of this weaponized dollar, all of these things don't bode well for oil prices in general is going higher and the petrodollar's longer term role. If that petrodollar, again, saw even a minor decline or minor fall in its power, the impact on dollar demand will be massive. So again, this is the question about what is the longer term staying power of the US dollar over time. And this is the classic debate with the milkshake theory and the dollar is still the strongest horse in the glue factory versus these slow but real processes of de-dollarization. All of it is tied to interest rates, Fed policy, but more importantly, it's tied to energy prices. And as I opened, as many have said who understand oil, the oil and energy sector is more powerful than the Federal Reserve. And the U.S. is facing a lot of pressures right now. It's not really managing inflation. I think John Williams from Shadow Stats was recently on an interview. He said the real inflation metric, if you measure it, as Powell is trying to be is trying to be Volcker. Well, if we use the same scale to measure inflation during the Volcker era, we're really looking at 11 to 12% inflation right now. And so when you add on to the real number of inflation as opposed to the official number of the BLS, which Americans and people in the West feel regardless of the official data. I always joke that Powell says we're data dependent, but that data is manipulated data. And it's like John Paul Juncker said at the European Commission, when the data is bad, we just lie. And I know that sounds like an incendiary statement or a sensational statement, but I think we all kind of feel it. We trust it. And so These are all very, very powerful forces. And inflation, it puts more stress on the middle class, that invisible tax. We cannot underestimate what's happening in the oil price and what's happening with the petrodollar longer term. And I think that will have a dramatic effect on the demand for the US dollar over the next 5 to 10 years.
And the interesting thing is that what we're seeing right now in the gold price is we're seeing a significant drop amid these geopolitical tensions here. Why do you think we're seeing this drop in the gold and silver price?
I think, again, people say this is just a gold bug apology or constant, defending anything. But I think we've been hearing a lot about the S&P over this year, making some massive rebound despite its huge losses last year. We've been hearing about the resilient labor markets. We've been hearing about the resilient economy and the resilient risk asset markets. Ironically, that's just the opposite. We can go into that. And of course, with my bias, but the simple facts are we have positive real rates, and normally gold should be getting shellacked right now. I think the most resilient asset this year has been gold. Remember, it wasn't long ago that gold was in the 1600s. We're now at 1850 as of this recording. Certainly not where we want it to be, but this is not atypical in the sense that when you have positive real rates and supposedly a victory over the war on inflation and an S&P rocking, and you're getting good yield on the long duration treasuries, gold should be really getting hammered right now. And the fact that it's not, and the fact that I think, let's not forget, gold loves chaos, and we're heading into more and more chaos. We've had a short-term pause, I think, in bad news becoming official news. There's been an incredible narrative out of the Western financial media, which is just the infantry for the political powers right now. It's a vertically integrated part of their messaging. They've been doing a great job of messaging a soft landing, a resilient economy, a resilient labor force. And I'll tell you in a minute why none of that is really true. But despite so-called resiliency in the S&P and a victory over inflation, which is way too soon to call, gold really hasn't fallen that far. And when you've got yields that are supposedly better than any yield you can get on a precious metal, you'd think gold would be getting hit harder. In fact, you're still seeing massive sovereign purchases and central bank purchases of physical gold. And so the price of 1850 to me is just a minor pullback ready for like a cannon going backwards. It's about to shoot forwards for all the reasons we can go into. But I think this narrative of a resilient labor force, of a resilient market, has bought some time. There's always a narrative. That narrative is becoming harder and harder to trust. We've had over 400 bankruptcies this year, twice the number of last year. We're hitting numbers we haven't seen since 2010. You've got massive layoffs at big companies like Google, Spotify, Microsoft, Amazon, even Goldman Sachs is about to have an 8% layoff by the end of this year. Companies like Google and Microsoft, Spotify, or even banks like Goldman Sachs, they're not doing layoffs unless they're not making earnings. So there is a correlation between what's happening at the Fed, what's happening in the markets. But that also means, when you're looking at layoffs and you're looking at bankruptcies at these levels, you're going to see labor stress. So the idea that the NBER or the Bureau of Labor Statistics can tell us that labor is still strong and unemployment is still at relatively solid levels, first of all, it's a lagging indicator. By the time the NBER tells us we're in a recession or that labor is being affected, we'll be knee deep in a recession. They're always a year too late. So, but the facts on the ground right now, in terms of just the labor markets, we're going to see those numbers come in if they're reported honestly. Those top 10 bankruptcies are 200,000 jobs. We've had 400 bankruptcies this year. Again, what we see with our eyes and ears versus what's reported officially isn't an apology for gold. It's just reality. Then in terms of just this soft landing narrative, I say it's Pravda-like. There's nothing soft about this landing. I joked in a recent interview, it's like the plane's crashing, the front tires are rolling down the runway, the engines are a mile and a half back in the woods on fire. If you look at the labor market, you look at the layoffs, but if you look at the leading, the Conference Board of Leading Economic Indicators, when it dips below that 4% threshold, we're in a recession. We hit that last December. When you look at even Oliver, Anthony singing songs, getting 79 million hits in a month on YouTube because he's talking about inflation, costs, the stress of the middle class, that's kind of a people's indicator. But between the year-over-year money supply growth, the Fitch downgrade, the Conference Board of Leading Economic Indicators, the massive layoffs, the 400 bankruptcies this year, there's nothing soft about that right now as we speak. So I think the soft landing narrative has given more hope for risk assets and put some of gold behind people's mind. But that narrative simply is empirically and quantifiably not a correct narrative. And as Now we see geopolitical stresses. You can't underestimate the power of what happens when things go wrong in the Middle East or in Israel in particular. And who knows? We've just started this, what the ramifications will be, what it'll mean for our funding of Zelensky now that we've got an ally like Israel under pressure. There's so many things that are changing. We don't have the money to create the necessary solutions to these problems. It's going to be very interesting times. But again, to your gold price question, up until recently, those narratives about a resilient economy, a victory over inflation, have kept a lot of people less aware of the real stresses on the dollar and the real pressures on inflation. And the idea that things are getting back to normal, that we've avoided this crisis. Again, remember, the same experts that told us inflation was transitory, the same experts that are telling us we're going to have a soft landing. I will argue, and I can argue empirically, that already we are in a very, very hard landing. And so I think when that becomes more obvious, when inflation now driven by oil prices becomes more obvious, when geopolitical stressors become more obvious, gold is poised to have some of its best times ahead. And the fact that they've stayed this resilient with real rates positive, again, real rates are positive because the Bureau of Labor Statistics tells us they are. But if you take the actual inflation number that we used measuring with the Volcker scale, we have negative real rates. I think my argument has always been, and that's what Powell wants. He can declare war on inflation. He can declare positive real rates. But if the inflation number he's using is inherently bogus, well, then you're taking the warts off a witch to make it look pretty. But the reality is we have negative real rates. The world's catching on. There's a lot of reasons why gold is going to do far more. China's making massive overtures right now with Russia to buy oil in yuan, in CNY. Then, of course, the gold price in CNY is different than it is in London or in New York. And, Chinese foreign minister said in 2014, it's a crazy world when gold is consumed in the East but priced in the West. But recently, China's been able to show that it can affect the gold price just by limiting imports into China and then turning them back on. I wrote about that over the weekend. Against a lot of information, but the simple fact is you don't need a BRICS-backed currency when you could just see a natural arbitrage right now in the BRICS nations, slowly repricing gold in their own, slowly buying energy in oil after converting it to yuan. There's just so much happening right now that it's impossible to say the gold price isn't enough, isn't strong enough, when the fact that it's at 1850, again, with positive real rates and a false declaration of victory on inflation, this is just the beginning. And when gold rips, and it will rip, silver will rip even faster for those who have the stomach for its volatility. It requires a tremendous amount of patience, a tremendous amount of conviction of what the real data is showing versus what the official narrative is out of the Financial Times or the Wall Street Journal or the White House or the ECB or the Fed. It takes a great deal of personal conviction to stick to your facts, not just gold bug facts, not just apology facts, but real hardcore math. I joke when I was in college in philosophy courses, the Kantian existential question was, if a tree falls in the woods and no one sees it, did it really fall in the woods? It's almost like the same with the Western media or the financial media trying to create this narrative. If they say we're in a soft landing, if they say we have resilient labor, if they say we have a resilient economy, is that really the truth? Well, the tree is really falling. We don't need the Wall Street Journal, the Financial Times, or Biden to tell us otherwise. And frankly, what we've seen in U.S. politics with McCarthy and Gaetz out of Florida, even the U.S., I mean, Gaetz said, drop the F-bomb in front of the national capital saying we're effing broke. Our country's broke. There's de-dollarization. We're broke. Even the U.S. House is starting to split. The Republicans, Democrats are starting to split. But we agree, and some of these politicians, for whom I don't normally have a lot of respect, are saying the quiet part out loud. Our country's broke. We've got another 1.9 trillion in net spending by the end of this year, another 5 trillion U.S. Treasury issuance coming in 2024. Simply, who is going to buy those IOUs? And all these pressures are happening. We're going broke. Oil's going up. We have geopolitical risk in the Ukraine. We have geopolitical risk in Israel. And we have a government that is structurally broke. And we have real inflation 4 times higher than officially reported. These are not apologies for gold. These are hard empirical facts that we're using real data dependence, not manipulated data dependence. And as that becomes more and more tangible and apparent to common sense, gold's days are still, its best days are still ahead of us. We've been saying that for a long time, but gold has still been outperforming risk assets. And so it's really not a gold apology. It's just common sense, patience, history, and math, all converging right now. The tailwinds for gold for patient investors, not gold speculators, but for patient investors, has really sadly never been better. And I was talking to my partner Egon, obviously we're excited about these geopolitical and financial and monetary convergences that are tailwinds for gold. But as we've always said, be careful when gold starts to prepare for a rip, because when that happens, things are going so badly in the world, and they're becoming more and more obvious, that, be careful what you ask for. Gold can certainly protect you against failing bond markets and diluted, debased currencies, but it can't protect you against all the other things that are going wrong geopolitically, with our personal rights, with our civil rights, with our censorship, and the other problems that are happening in the U.S. and in Europe. So, it's a good news, bad news scenario, but I think for gold investors, again, I'll say it with conviction, its time hasn't even come yet.
No, it seems like at least some of this common sense may be hitting the stock market right now. We're seeing quite a decline in the last month or so. Do you think this is the start of kind of a further crash? I know we had, a good rally in the beginning of 2023, but, the stock market did dip negative for a little while there. So your perspective?
Well, there's a lot of things. People talk about what a ripping year we've had in the S&P, the NASDAQ, the Dow. Dow's already down 200 points today, by the way, as of this recording. That's irrelevant in the longer picture. But you can't forget that last year, the combined stock and bond performance in the U.S. was the worst combined. These are supposed to be hedged assets. One's supposed to zig while the other zag. But we saw a highly correlated fall in both treasuries and stocks last year, the worst since 1871. Let's not forget that. So even the temporary euphoria that we saw a little bit in the S&P this year, the Dow, was based on this narrative that the Fed had our back, that we were controlling inflation, that we were still a resilient economy, and all was good in the world. But even that was just trying to catch up with last year's losses. We haven't really netted an extraordinary market. What we have seen at the same time, in the beginning of this year, we had 3 of the 4 largest banks fail in our history, and that seems to be off the headline. There's a sin of omission. Let's just ignore the bad, focus on a good. The good is mostly platitudes. It's not based on math. The bad is very real, but we ignore it. We tend to narrate over it. But rising rates aren't just about data points for the Fed to declare victory or positive real rates or declare victory on inflation. Rising rates mean the cost of debt gets higher. The cost of debt doesn't just affect bonds, which are tanking and yields are spiking. It also affects the stock market, because those players on the stock market, the S&P 500, let's not joke, it's really the S&P 5 to 7. There's a few names holding the whole thing up. And even those companies are seeing more layoffs and more cuts, because the cost of debt is the wind beneath the wings of the equity markets. And as the cost of debt gets higher, those companies can no longer use easy leverage to buy back their own shares or tweak their earnings per share data. They can't extend and pretend like they've been doing for years, since 2009, 2010. So you're going to see stress in the S&P and in the overall equity markets when the cost of debt gets higher. This higher for longer policy has a direct impact on the stock market. And so as these rising yields, this higher for longer policy continues, it puts stress not only on the on the bond market, but most importantly on the stock market. And I think now you add a geopolitical event, you add rising oil costs, you look at what's happening at the U.S. House, at the Speaker of the House, you look at these confessions that were broke, you look at the amount of U.S. Treasuries about to be reissued again at the back end of this year and into 2025, you look at the fact that our TGA account is empty because we emptied it a year ago in September. Who's going to buy the next $7 trillion in U.S. Treasuries? Who's going to buy them? We're seeing a net sale of treasuries by foreign investors. There's $7.5 trillion globally in U.S. Treasuries held outside of the U.S. Those are being sold off to create liquidity. So as foreigners are selling U.S. Treasuries, and as the U.S. Congress and the U.S. Treasury and the Fed are going to be issuing more Treasuries, there is a massive empirical mismatch between the supply of those U.S. Treasuries going out into the world and the lack of demand for them. And already Yellen has talked about, or this guy Josh Frost at U.S. Treasury have talked about the Treasury buying its own bonds back to make the market more resilient. But again, where does that money come from? The bottom line is, as we issue more and more debt and increase the cost of that debt simultaneously, and there's less buyers of that debt, you have to ask yourself an honest question: where's that money going to come from? And my argument has always been, it's just the fiscal dominance argument we talked about last time, and that even the St. Louis Fed talked about in June of this year. The buyer of last resort of those treasuries is going to be the Fed, which means there's going to be more liquidity, synthetic liquidity. We had it from TGA last year. We had it from the BTFP program early this year, backdoor liquidity, not official QE liquidity, but we're running out of liquidity. And so at some point, and don't ask me what month or day or year, but very soon, the Fed's going to be forced to save the dollar or save the bond market. And it will save the bond market. It will have to create synthetic liquidity. That will be inherently inflationary. That will be a massive tailwind for precious metals when that moment of reality comes, when we hit that Gettysburg moment where we realize there's no way out. It's important for viewers to understand Fed policy can do what it can save the bonds or it can save the currency. It can save the bonds by going back to QE and more balance sheet expansion and lower rates. That will be great for bonds. That'll be terrible for the US dollar. It can save the dollar by rising rates and going into QT, which is what we've been seeing for the last 18 months. But look at the ramifications of that. At some point, the Fed will have to make the choice between saving the system, because the bond market saves the equity market and the pension fund market and the stock market, or the US dollar. And the US dollar is too strong right now for a number of reasons. At some point, and the last bubble to pop throughout history is always the currency bubble, even for the world reserve currency. So when you add on this amount of debt with de-dollarization slowly unfolding, it doesn't bode well longer term for the US dollar. What we're seeing right now is a short-term rally in the dollar based on interest rate policies, which are not sustainable. When you look at the fiscal policy of the US, the amount of debt we're into, our deficits, the amount of treasuries that are about to be issued, the lack of natural buyers for those treasuries. Those buyers are not there, so the only buyer of last resort will be the central bank. We will see this pivot. And the simple fact is, even Powell's war on inflation, by raising the cost of debt at the same time that Congress is expanding debt, it is, I hate to overuse this word, the perfect storm. Because the only way to pay the interest expense on those U.S. treasuries, which are over $1 trillion a year, is to print more money, because we're not going to cut spending. We're not going to cut entitlements. And now, with what's happening in Israel and in Ukraine, we're not going to cut our military budget. So if we're not going to cut spending, we're going to have to create liquidity from somewhere. And it's not coming from tax receipts, and it's not coming from GDP. It's going to come from that, I hate to say it, that magical mouth clicker, that Fed policy. And I think the reason Powell's been raising rates and cutting the Fed balance sheet over the last 18 months is because he knows there's a recession already here and a bigger one coming. This is a way to reload both revolvers, because he's brought the balance sheet down a little bit, a marginal amount, and he's raised rates enough so that the next moment comes in the markets, he'll be able to cut rates because he's got now rates to cut and expand a balance sheet that he's reduced. It's just prepping. It's just prepping for the inevitable recession that hasn't been made official yet. At the same time that Powell is prepping for a recession, the rest of the world is prepping for a devaluation of the US dollar. That's why you're seeing record-breaking sovereign and central bank purchases of physical gold. It's like a military analogy. If you see a country putting cannons and horses and soldiers on the border, they're prepping for something. When you see central banks making record-breaking level purchases of physical gold, they're prepping for something. They're prepping for the inevitable debasement, dilution, and distrust of a weaponized world reserve currency. These are not gold bug defenses. These are common sense facts on the ground right now. And you add those facts with what's happening in our real economy, our layoffs, our bankruptcies at record numbers right now. The narrative out of DC, the narrative out of the financial press simply is incommensurate with the facts on the ground. And that, thanks to platforms like this and other conversations, is becoming more and more understood by the general populace. More importantly, it's being felt by the general populace. Again, you take a guy like Oliver Anthony, probably doesn't follow Fed policy, probably doesn't know QE versus QT or what yields on the 10-year, the DXY. But what that 79 million supported hits on YouTube is saying is everyone feels the inflation, everyone feels the distrust, everyone feels the shifts. So between social issues, geopolitical issues, oil issues, and monetary policy, I've never seen a macro environment this fragile, this broken, and I've never seen a debt level so unsustainable as we're seeing right now. Again, that's certainly a tailwind for gold. That's not a gold bug defense. That's common sense, Elijah.
I think that's very much needed now, more common sense these days. We really appreciate your work over at Matterhorn Asset Management. We'll link to your articles there. Any last thoughts before we let you go, Matthew?
No, I think we've covered a lot of ground. I just think this larger issue of distrust, which is harder to quantify, this larger issue of, what the heck's really going on, as more and more people become informed, if you take the time to look at the math, you look at the U.S. Treasury markets, you look at the yields, you look at this disconnect between what's happening in DC with issuing more debt and the inability of buyers to buy that debt, and the lack of buyers for that debt, that supply and demand mismatch is a very simple indicator that at some point that bond market has to be saved, and the only way to save it is going to be instant liquidity, synthetic liquidity. That's going to be highly inflationary. And I think if you look at the real inflation numbers from John Williams, or using the Volcker scale, we're all feeling 12 to 11% inflation. So you have to ask yourself, how do you trust a system which is supposed to be data dependent when that data is manipulated? How do you trust a policy out of the central bank or the US Treasury when they no longer have buyers for their IOUs? These are not trying to be gloom and doom, gold bug, fear mongering. These are just real hard, simple math questions for which there are no easy answers, Elijah. And I think it's going to be a very difficult next 6 to 12 months.
All right. Well, Matthew, we really appreciate your time and insights today. Thank you so much, and God bless.
Thank you, Elijah. Great to speak with you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.